Breaking. Today, March 18th, the Federal Reserve is meeting right now, and the decision they make in the next few hours is the most consequential interest rate decision since 2008. Here is why. Before February 28th, before the bombs fell on Iran, the U.S. economy was already losing steam. Brent crude sat near $70. The forecast was cautious but manageable. Then Operation Epic Fury launched. Oil briefly touched $119. It has stabilized around 90 to 110. And that energy shock has collided with a domestic economy that was already on the edge. Let that land. Trump promised 2026 would be a roaring economy. Instead, it has kicked off with job losses, rising gasoline prices, and more uncertainty than at any point since the pandemic. In his State of the Union address, Trump told the country the roaring economy is roaring like never before. The latest data tells a different story. The February jobs report was a significant miss. The economy shed 92,000 jobs, far worse than analysts expected. The unemployment rate ticked up to 4.4%. December was revised to a loss of 17,000 jobs. Without the healthcare sector, the economy would have shed roughly 202,000 jobs since Trump took office. 202,000 jobs gone before the Iran war added 65 cents to every gallon of gas. GDP grew just 0.7% last quarter. The government shutdown shaved 1.16 percentage points off that number. America still has an inflation problem, one that will worsen if the Iran war continues to disrupt global energy markets. The cross-current of intensifying price pressures and ongoing fragility in the labor market puts Federal Reserve policymakers in an impossible spot. An impossible spot. That is not my framing. That is economists describing the Fed's situation today as it meets to set interest rates. The 30-year fixed mortgage rate spiked last week from just over 6% to nearly 6.5%. Higher mortgage rates, greater market volatility, and increased economic uncertainty could weigh further on the housing market as the year goes on. The energy shock from the Iran war has not yet fully shown up in inflation data. When it does, the Fed faces a choice it has no good answer for. Fight inflation with rate hikes, or protect jobs with rate cuts. It cannot do both. It cannot do both. Goldman Sachs says no rate cuts in 2026. Morgan Stanley assigns 15% probability to mild recession in the first half of the year. Consumer confidence has collapsed. High cost of living is the #1 concern for American voters ahead of midterm elections. Trump said the economy is roaring. 92,000 jobs disappeared in February. Oil is above $100. The Fed meets today with no good options, two statements. They cannot both be true. Subscribe to Ziv Iran and hit the bell.